This week, Apple flooded the zone with new products, including its most affordable laptop ever. The company also kicked off a massive, exclusive sports rights deal with Formula One. Yet, the stock ended the week in the red. So why did investors react so coolly to what looks like a major push for growth? We'll dig into whether this is a breakout moment for the company's ecosystem or a risky gamble on its profit margins. Welcome to TickerWatch News for Apple, Week 10, 2026. This is the weekly podcast that breaks down the essential news and developments for Apple. We'll cut through the noise to bring you the facts and figures that shaped the last 7 days. Stock Snapshot. Looking at the week from February 27th to March 6th, it was a downward trend for Apple stock. The share price began the week at $264.18 and closed at $257.46, marking a weekly decline of about 2.5%. This happened in the context of a broader market sell-off, with the Dow Jones falling nearly 3% and the Nasdaq 100 dropping about 1.2%. Most of the so-called Magnificent Seven stocks were under pressure, partly due to geopolitical jitters. The takeaway is that while Apple's new products generated buzz, its stock was pulled down by wider market fears and specific concerns on Wall Street. Top news and headlines. Apple made a flurry of announcements this week, signaling a significant strategic push on two fronts: affordability and services. The biggest story was the launch of several new products aimed at budget-conscious consumers. The company unveiled the MacBook Neo, its most affordable laptop ever, with a starting price of $599 or $499 for the education market. This was accompanied by the iPhone 17e, also priced at $599, which doubles the base storage of its predecessor. These products are designed to compete directly with Chromebooks and entry-level Windows PCs, targeting students and first-time Mac or iPhone users. The goal appears to be widening the entry gates to the Apple ecosystem. However, despite the positive buzz among consumers, Wall Street reacted with concern. The stock fell following the announcements, with analysts pointing to potential pressure on Apple's famously high profit margins. Those worries were compounded by news that Apple is simultaneously raising prices on some of its higher-end MacBook Pros and Airs, citing a global memory chip shortage. This highlights the difficult balance Apple is trying to strike between expanding its user base and managing rising component costs. The second major headline was in the services division. Apple TV began its exclusive multi-year streaming partnership for Formula One racing in the United States. The deal, reportedly worth around $150 million per year, moves the popular motorsport off traditional broadcast on ESPN. Apple's plan involves deep integration with special content on Apple Music and detailed track renderings on Apple Maps. In a surprise move, Apple also struck a deal with rival Netflix to co-stream the popular Drive to Survive docuseries, a first in Netflix history. The market's reaction to the F1 deal has been mixed. Some investors reportedly called it a disaster, fearing the move to a subscription service would shrink the sport's growing U.S. audience. Others, including analysts at Wolfe Research, disagree, arguing that Apple's ecosystem provides more touchpoints for fans and is better suited for a global sport with races at all hours than traditional TV. Market reaction and investor sentiment. The divide between Main Street excitement and Wall Street caution was clear this week. Retail sentiment, reflected in social media discussions, was largely positive about the new, more affordable MacBook Neo and iPhone 17e. Professional analysts, however, were more measured. UBS and Jefferies both held neutral ratings, suggesting that Apple's near-term growth is already factored into its current stock price. In contrast, Wedbush reiterated an outperform rating with a $350 target, viewing the product blitz as a key catalyst for future revenue. Analyst Gene Munster projected the MacBook Neo could add about 0.5% to overall revenue without hurting the company's profit margins. Overall, the narrative was bearish on Wall Street, where concerns about margin pressure from cheaper hardware and rising memory costs outweighed the potential for ecosystem growth. The stock's price action for the week aligned with these analyst concerns, not with the enthusiastic consumer response. Technical and fundamental check-in. From a technical standpoint, Apple stock is in a short-term downtrend. It fell over the past week and month and is down about 5% year-to-date. Fundamentally, the picture is complex. Apple is trading at a price-to-earnings ratio of about 32, a notable premium compared to the broader tech industry average of around 25. This suggests investors are paying more for each dollar of Apple's earnings based on high expectations. This week's news encapsulates the central debate, the growth versus risk narrative. The bull case is that lower-priced hardware in premium content like Formula One will attract millions of new users who can be monetized through high-margin services. The risk is that these strategies compress Apple's sector-leading profit margins, especially as the company also faces higher component costs for its premium devices. What to watch next week? Looking ahead, the focus will be on the real-world reception of Apple's latest moves. Monitoring initial reviews and sales indicators for the new MacBook Neo and iPhone 17e will be key. This will provide the first clues as to whether the budget strategy is successfully expanding the user base or simply cannibalizing sales of more profitable products. Likewise, viewership numbers and subscriber feedback for the Formula One season premiere on Apple TV will be a major test for the company's big bet on live sports. From a market perspective, a key bull scenario would see investors begin to prioritize ecosystem growth over short-term margin concerns. The bear case is that margin pressure proves significant, and the F1 investment fails to drive enough subscriber growth to justify the cost. For now, the most likely path is a continued tug-of-war as the market waits for hard data on how these big strategic bets are paying off. Outro. Thank you for tuning in to TickerWatch. This podcast is for educational purposes only and is not financial advice. Please do your own research before making any investment decisions. Be sure to subscribe and feel free to share this episode. We'll be back next week with another update.